It's usually better to drive with an eye on the road ahead, but an occasional look into the rearview mirror can prove to be very useful. Speaking of the auto sector and auto stocks, that is exactly the case. The economic situation now has striking parallels with that of 2002. Yes, 17 years back, the scenario was very similar. Weak economy, bad loan stress in the financial system, stagnant corporate capex, and falling corporate earnings for many consecutive quarters had completely shattered both consumer demand and investor sentiment. Banks were struggling with with bad project loans and were unwilling to lend. The savings to GDP rate had fallen to 24.6%. Consumption demand both in the urban and rural areas had taken a big blow, which is why FMCG majors like Hindustan Lever and Dabur were reporting lower earnings quarter after quarter. And like is the case now, companies were asking the government for fiscal stimulus. Auto stocks, needless to say, were amongst the worst affected. But then, some structural changes in the economy literally pulled it out of the low GDP growth trap. What happened? First, the savings rate as a proportion of GDP went up by almost 10 percentage points from 2002 to 2007, from 24.6% to 34.6%. This splendid rise in domestic savings was led by fiscal consolidation as well as an improvement in corporate financials. Higher savings rate meant that the subsequent investment boom could be largely financed from domestic sources. What followed was a huge wealth creation in equities and particularly in auto stocks. Stocks like Maruti, Tata Motors and M&M went on to gain 7 times, 15 times and 24 times in the next decade. Of course, this is not to say that the economic recovery and the turnaround in auto stocks was very quick. It definitely took some time. But an economic revival tends to have a multiplier effect on the auto sector. Looking at the investor sentiments toward the sector now, it's literally at the trough. But instead of a V-shaped recovery, it may take some time for the sector to win back investor confidence with better earnings performance. Stocks of most auto majors are back to post-demonetization levels, and in some cases the valuations are near 5-year lows. That the sector will have to go through the disruption of switching to electric vehicles and cleaner fuels is absolutely a given. But with more time to adjust to this change, the companies will have more options to plan their investments. So while I do not expect the auto stocks to sport a dramatic recovery very soon, I do believe that buying the best businesses that have a track record of overcoming such economic cycles could be extremely value accretive to investors over the long term. Thank you.